This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
This week's Postgame chart deck is titled, What's Next for the Markets? Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, look for the red button that says Looking for the Downloads. Patrick, what's next for the markets?
Well, let's start on page 2 with the S&P 500. And one of the key things that I was watching going into this week was whether or not the bulls were able to get the market back above 4,000. It was a fib level of the last sell-off and kind of a simple round number to watch for that sort of descending trend line that connected all of the previous highs during the sell-off. We've been incredibly oversold and overdue for some sort of a bounce, and the fact that the market tried to break to a lower low last week and failed to follow through has potentially now sparked the beginning of some sort of a short-term mean reverting correction. By no means am I calling this a major market bottom or the bottom. In fact, this could be something that echoes a lot, maybe even a weaker version of what we saw in March, which could be one of these 400 S&P point moves to the upside. Maybe we'll see 4,200, 4,300 on the upside of a bounce. But then it'll be the real tell as to whether or not that it was just a very oversold little snapback that begins a new round of selling into the summer, or whether a more meaningful bottom is in. But right now, I think that we're overdue for a bounce, and a couple hundred more S&P points are totally on the table.
I agree, Patrick, and I think what will decide whether it's just a bounce and just a couple hundred more S&P points, or if we're looking at 1,000 more S&P points, is going to be whether or not this idea that the Fed's hiking cycle is ending after 3 more hikes really turns out to be supported, or if it's just wishful thinking. I think once we get more indications on what's coming with inflation, we'll know more. Let's take a look at the euro-US dollar cross on page 3.
Yeah, and what I wanted to do is focus in on the euro, and one of the things to highlight is that while the US dollar did break out to a higher high in the last sequence, the euro came down and traded right down to its 2017 low and bounced off of it down there just below the 104 level. And so really, it was a pretty key technical support bottom where we got the reactionary bounce. But that's, again, the same story as we talked about the dollar at the market wrap at the beginning. Obviously, we had a very oversold euro coming to a major support line. Typically, a reaction off of a support is a typical technical event. Now the real question is, do the bulls have more gas in the tank to be able to see the euro work its way, let's say to 108 or 109 on the upside in the coming weeks? I think on the short term, the dollar is put in a short-term high, and the euro is put in a short-term low. But the real question is going to come in the week or two from here, where we see whether or not they have follow-through after this little bounce. But moving on, Eric, I wanted to move to page 4, where we have the crude oil chart. And I specifically put on the July contract, because when you do the continuous, it shows those highs from the spring that were up in closer to $130. But when you go to the July contract, it really does look like crude oil is attempting to break out to a fresh high based on this contract. And really, we have seen very healthy accumulation, higher highs and higher lows. Only thing standing in oil's way right now is that previous high. And it's going to be one of the key things to watch. If it does break out, we could really see an acceleration of the oil move to the upside. Maybe at that stage, we could see 120, 125 in week. It'll be really interesting to see whether this follow through can happen today and tomorrow.
Well, Patrick, as you say, the continuation chart and the contract chart look completely different right now. Normally, we don't even discuss that nuance on MacroVoices because it's kind of one of those futures traders cocktail party trivia things that nobody really cares that much about because the charts are almost the same. Now, they're not at all the same. If you look at where we are at 114 there, looks like we're almost back to that early March peak again, and we're well above the peak from late March. Well, actually, on the continuation chart, we're not even back to the same level as that second peak, the one from late March. So what's the rule here? If you've got a different story being told to technicians from the contract chart versus the continuation chart, which one do you go by? The answer, as far as I can tell from quite a few years of doing this, is nobody's really sure, and different people do it different ways. And what that means is that in situations like this, the market gets a little bit harder to predict because what is the level at which we break out to a new high? According to the contract chart, it's above 116 or so. According to the continuation chart, it's above 130, 131 in there someplace. When we get above both of those, and I think we are going above both of those, that's where you're really going to see the acceleration. But does the acceleration to the upside happen on a breakout above the previous high on the contract chart, or do we not really get it until we get to a new high on the continuation chart? In my experience, it's really hard to predict those things. Kind of depends on the mood of the market. We'll see what happens.
Well, to kind of add to that, I think the oil traders that are actually trading the real futures are watching the July contract. So this is this price action is pretty important. I think it's more of the bigger macro people that are looking at those continuous charts that give you that rich back history that you look for to do some technical analysis over multiple years. The one interesting thing is that when you use something like the USO ETF, which tracks, obviously, it's an ETF for crude oil, but that one is actually almost mirroring this July contract, and we're actually approaching a fresh breakout on that USO, which obviously is a blend of multiple expirations in there, as opposed to rolling only that front month contract. And I think so. A lot of technicians that are using real trading vehicles are going to see that break to a fresh new high. So I think that is significant.
That's a really important insight, Patrick, because the way the USO ETF used to work, it would have been tracking the continuation chart because they used to be almost entirely in the front month contract and they rolled it every month. Now that they've changed and it looks more like this, I think that could surprise a few people because I hadn't thought of that until you just mentioned it. So now that the USO, which is driving a lot of the volume, is potentially going to give us an earlier break signal than it would have previously, I agree with you. And I also agree that most traders who actively trade short-term are looking at the contract chart, not at the continuation chart. So that further emboldens the prediction that once we get a breakout above 116 spot, whatever it is, on the contract chart, the previous high from early March, that we could see some pretty significant upside. I would say, though, that there are much bigger factors than just technical analysis in play here. If we get another escalation of tension in the Russia-Ukraine situation, that could easily skyrocket us straight up. And if we had a sudden batch of information that caused most market participants to think that a recession really was imminent, well, that could cause a pretty significant dip. So we'll see what happens, but I agree with you that the stage is set for an acceleration to the upside as prices continue from here. Let's move on to page 5, where we've got the natural gas contract. This one, you've got the continuous contract.
Right. And what I want to highlight here is both gasoline futures and natural gas futures have broken out. And that can only further kind of give support to this idea that oil is capable of making that move. I mean, we're now at $9+ on the natural gas futures. Looks like $10 is imminent. And this trend is so strong. Like when you go back to May, at the start of May, when we had that 2-day sell-off, typically a market after that kind of a heavy technical hit would begin some sort of sustained distribution. And instead, the buy on dip traders came right in, scooped it up, and took this right back to fresh new highs, just showing how strong the buying pressure remains in the nat gas market. Really, by far, one of the strongest trends that are out there right now.
Now, this is a really important one, Patrick, because it would be so tempting to say, well, look at that, $9. You know, markets always mean revert. $9, that's just way higher than we're used to seeing on natural gas. Surely it's about to come down. Here's the way you want to look at this. Natural gas prices in Europe are equivalent to more like $30, not $9. And although normally, because the transportation cost of natural gas is so much higher than crude oil, you don't really see an arbitrage of those prices. But there are several analysts that have expressed what, to my thinking, is a very credible view, which is that U.S. and European natural gas prices are going to converge over the next 6 months. One of the reasons is President Biden has promised the European Union that the United States will provide as much liquefied natural gas as Europe needs in order to not have to resort to buying any more gas from Russia. Well, hang on a second. President Biden made that commitment without considering a couple of minor little details, like the fact that we don't have any really substantial natural gas export terminals. We don't have enough natural gas ships in order to deliver that amount of gas from the United States to Europe and so forth. So it's not going to happen right away, but I think there are a number of reasons to anticipate that natural gas is going to become much more scarce. We're eventually going to get to the point where we're not just flaring it off and wasting it. And as that happens, I think there will be a global convergence of natural gas prices. I'm not sure if that actually helps to bring European prices down, but I do think that it would be a mistake to think, oh, well, historically, $9 is too high. Surely it's time for this natural gas market to revert to the downside. I think they could double from here very easily. We'll see what happens before the summer is over.
All right. Well, I wanted to wrap up with looking at the charts of gold and copper. And what I wanted to simply highlight is it's really interesting that gold really seems to be behaving at this moment like a cross currency to the U.S. dollar. Just as the U.S. dollar put in its short-term peak, gold put in some trading low. And just as you saw on that Euro chart bouncing, we're seeing gold bouncing similarly. And so right now, it'll be interesting to see whether at some point gold decouples from that and starts kind of marching to the beat of its own drum. But right now, it really just does feel like it's one of these cross currencies against the US dollar, and maybe that's the most prudent way to approach it on the short term until a catalyst emerges to change that market. But I wanted to also just highlight how similar copper's chart looks to gold. It had a very sharp sell-off, similar bounce off of the short-term low of the dollar, and these basic materials really have been under a lot of pressure with obviously the risk that the global economy is slowing. But it'll be interesting to see whether or not copper has put in the low, or whether or not it can actually hold these key support lines from the 2021 lows. Nonetheless, we are getting a bounce off of a pretty key level. It'll be interesting to see whether or not that it holds in the bigger picture.
It sure will be, Patrick. And, you know, it's fascinating. If you look at this chart, which goes back a couple of years now, boy, it sure looks like we just hit that low right above $4. You know, can't get all the way down to $4 because surely if you look back 2 years, it never goes that low. Well, if you go back a bit further, $4 used to be kind of the high that everybody assumed. If it gets as high as $4, surely it won't go any higher than that. So we do have a new regime here where what used to be the ceiling has become the floor, and I think it's going to stay the floor. So if we get another test of $4, it might be tempting to buy some of those copper futures. What's even more tempting, though, is to become a member of Big Picture Trading so you can get Patrick's chart text every single day of the week. You can find the information for that on page 8 or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com. the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.